So this is all about updating based on the RMLS market action, but start off with a couple just sort of big picture items. You've heard me refer to what is being called a square root recovery. That's actually made some national press and been quoted, various publications. Started in the early April. It's not original, but it was first sort of promoted this way from the Oregon Office of Economic Analysis. And keep in mind what this is. What is this economic downturn and recovery going to look like? And the speculation under this model is you have a very steep drop followed by a partial recovery, 50, 60%, and then a continued recovery until essentially some sort of solution to the health concerns are, whether it's therapeutics or vaccines or what have you, to COVID, and then from that time going forward. Okay, so note that shape. The various models being discussed, and these are the things that you might hear from your clients. So having a general familiarity as to what the hell they're talking about is probably useful. You probably heard about a V-shaped recovery. Drops quickly, comes back fully. A U-shaped recovery, drops quickly, comes back a little slower. Interestingly, on a national basis, and I guess this is a credit to Nike, they're now calling what I was referring to as a square root recovery as a swoosh-shaped recovery. And I've seen publications, national and international, refer to it as the Nike swoosh-shaped recovery. So let's hear for the local brand. Idea there is steep drop, comes back a little bit faster than a V shape, a little bit slower than a U shape. There's also the Z shape, which involves a lot of federal money going into stimulus and actually brings us above where it would have been otherwise. A W shape, which has a possibility if there's a resurgence of the virus. And then an L shape where it drops and never fully recovers. All right, we can discuss sort of the assumptions behind those at another time, but I wanted to get that out there because I thought, these are the things your clients are going to hear, they're going to talk about. I don't know if they might come up with 26 of them to match every letter of the alphabet or not, but nonetheless, that's the general shapes of what an economic recovery is forecasted to be by various people. And you'll hear arguments pro and con on all of those. Some level of familiarity will probably be useful to you. That's the general economy. We're more concerned about the real estate economy. Let's go to that. So central lock daily activity counts. We didn't have one last week, so what we can see is the big drop off early March when the stay-at-home restrictions went into place and then dipped down even more. And we've seen something of a recovery the last few weeks. So for instance, back on, let me get my dates here, 2 weeks ago, Sunday spiked up, got up to 2,600. Mother's Day, we're looking about 2,400. This past Sunday, we're about 3,100. So it's about a 30% increase from a week ago Sunday to this Sunday. These are just the high points, the numbers between them, but you can see an uptrend. You've certainly seen that. The point being that visits to homes have increased significantly. They're not overly up to what they've been in past years in this range, still below those numbers, but showing activity has picked up. Status changes in RMLS. All right. Last week, on week ending on Sunday the 10th, every number was down from the week before. New active listings, back of markets were about the same. Price changes were down. Off markets were down. Pendings were about the same. Solds were down significantly. This last week, those numbers all turned up, every single one of them. Actives were up, back markets or whatever. Price changes were up, off markets up, pendings up, pendings up quite a bit, closings up. So, you know, up, down, whatever, there's more stuff happening. You know, we had in this range, we had 4 straight weeks of pendings going down from 640 to 480 to 420, 465. With that sort of thing, we're going to be looking at in this range fewer closings. So the question you want to pay attention to is if our pendings are down, and we'll cover this more later, what does that look like for May and June closings? Okay. Home prices, this is the long-term chart. The important thing to note is that we are pretty much following the seasonal pattern. I've commented about this before, up the first half of the year, back, up the first half of the year, back, up the first half of the year, back. All right, well, we're seeing up the first half of the year. So the question is, when will the slide back occur? Typically that starts occurring July, August, September. What's going to happen when we have a 6-week break this year? Is it going to be just a lost spring, or is everything going to be pushed into May, June, July? Don't know. We'll see. Sale prices. Sale prices are holding. Last month we were at 425. March 425. April we're at 424. That's virtually the same. That's a rounding error. Okay. So interestingly though, it's up a bit from my slides are out of order. Oh no, never mind. So if you look then at what it was from December to March, basically the first 4 months of the year. So December last year went from 390 to 405, about a 3.8% increase. This year went from 405 in December to 424 in April, 4.7. So we had the benefit of some pretty healthy price increase in the first 4 months of the year. 4.7% in the first part of the year is pretty respectable. And that's basically going to help us a lot going forward. You've seen this board before that talks about a month-over-month change. Keep in mind those numbers are not going to add up to what it is between April and December because of compounding technicality. But you can see that typically April is up. Now this last month it was down a little bit, but again, that's a rounding error, 424 versus 425. But typically April closing prices average about 2.5% increase. And we see that through the year. Watch those numbers. They'll determine what's going to happen for the balance of the year. Okay. By the way, y'all got emailed this thing a half hour ago. So if you want to scribble on it, there you got it. Just a reflection back to mortgage rates. And this is just a reminder that there's a pretty strong correlation. It's not a direct causation, but there's a strong correlation between 10-year treasury yields and fixed mortgage rates. There's a lot that goes into one becoming the other, and we've seen it not follow too terribly closely lately. But the important thing is this green line is the spread between the 10-year treasury yields on a constant maturity monthly basis, blah, 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 and what Freddie Mac says the average mortgage rate is in any given month. And that spread has typically been around 1.65% in that range on average. You can see, though, when there's economic turbulence, that spread widens. And that's what we saw. We saw it in early 2009. We saw it historically back with various recessions or market crashes. Okay, right now, this morning I checked the 10-year spread. They're not. They're a 3.25, call it. So there's a wider spread on long-term mortgage rates than would above the historic average. Why? The market's turbulent. I mean, lenders are a little bit squeamish still about all the forbearance issues and potential job losses and all that. Nonetheless, that gap at some point will narrow. And the question is, will it narrow because treasuries go up or will it narrow because mortgage rates come down? That's the conversation you're going to have with clients. Buyers are going to say, I'm just going to wait for mortgage rates to come down. Maybe, but they may not. There's speculation all around the block on that. If they do come down, how much? My guess is they'll come down a little bit under 3%, but I wouldn't be waiting too long for anything more than that. The issue is the turbulence. They will narrow when things settle down. Affordability. Okay, came across an interesting math is done. Affordability typically is measured by what the area median income is for a family of four according to HUD. That number is 92,100. I put all this in here so you can see it. Okay, if that family is affordability is if that family is spending 25% of its or less of its income on a mortgage. So with a 80% mortgage, medium home price, so call it $425,000 home, 3.3% mortgage, monthly payment on that is about $1,489. That is about a little under 20% of the monthly income. So on that basis, homes in Portland are affordable. If incomes will stay the same through the year officially, prices, if they come down a little, makes it more affordable. Interest rates come down a little, make it more affordable. Now, if you're, this is obvious, this is statistics, so this can change based on the realities of individuals. But the argument here is Portland overpriced. Portland's pretty affordable. Here's an important slide to keep in mind, though, as a contrast. This is a Shiller Case Home Price Index. I mentioned Robert Shiller before. He's got a whole department of grad students in the finance department at Yale, cranking out all this data. And this one shows what home prices have been as a function of income. And historically, prices have been in the neighborhood of 3 to 4 times income. All right. So if we're at 4.25 and income is 92,000, that's about 4.6 times income. So based on this, prices are a little high in Portland. So how is it affordable here and a little high here? It's 80% of affordability threshold here and a little bit high here. Interest rates historically, well, they've been, depending when you want to measure sense, but if you want to go back about 30 years, interest rates have averaged a fraction over 6%. Okay. If we're now at 3.3%, that makes these numbers a lot more affordable. So this is just for, you're going to hear a lot of stuff when people talk about what is affordable. Well, one rule of thumb is 3 to 4 times your income. But another is you got to factor in the cost of financing. All right. Active listings. Total active listings went up in April. Okay, month to month, they're up about 13%. Year over year, however, going from April a year ago down, they're down about 12%. So that, when we get to our inventory numbers, that's a factor. So no, up month to month, but they're up month to month most times. Simply, we usually have more listings in April than we have in March. That is true now, but not as much as typically in the past. All right. New active listings. These are the ones that came on the market in April. All right. They are down. They are down from March. They are down from a year ago. They're down 30%, 32% from a year ago, and they're down 18%. So the question then is there a backlog waiting to come on the market in May and June, or is this the year that people simply don't go on the market? If you look back at that earlier slide about the week to week, in the last couple of weeks, about 1,500 new listings came on the market. Extend that out for the balance of the month. Are we going to be in the neighborhood of 30,000, 3,200, something like that in May based on that? Or is it going to be a surge? Because even if we got in the neighborhood of 3,500, that's still going to be well below a typical May. All right. So what is that doing for inventory? There's a lot of conversations going on about, people are asking, are you bringing on listings? And of course, those who have lots of listings are say, yeah, I got 4 listings coming up. And those that don't have any are not saying anything. So whether asking a group of people is a good indication or not, don't really know. This one I created new because I got curious because I'm kind of strange that way. And I decided to say, how many listings, if you take all the active listings and you subtract from it the ones that are new in April, in other words, take this slide, all these numbers minus the corresponding numbers there, you have old. And I want to say, okay, how many listings are more than 30 days old? Usually you would say that they are in danger of being stale. Is that the case now in a COVID environment? But the point is, there are 750 listings more than 30 days old at the end of March. And in April, that number's 2.5 times as big. All right. What does that mean going forward? I mean, what it probably means is you're going to have conversations about, and I mean, I've had this. I've had people call and say, why has this listing been on the market a month? And I pretty straightforward answer, excuse me, there's, a virus out there. Nobody visited for 2 weeks. But those are the conversations we're going to have both on the buyer side and the seller side. Okay, closed sales, total closed sales. Keep in mind, these are the numbers that are going to feed inventory. This is just a long-term number, and what you can see is the heavy seasonal variation, up, down, up, down, up, down. So you have to be careful what you're comparing. The black line is a 12-month moving average, so that takes the seasonality out of it. And what we can see is, based on that, we've had it going down, but there's an interesting uptick. So if you dig back in those numbers, which will come up on the next slide, what does that look like? Because we have a downturn in total listings, total closed sales, and an upturn based on the last 12 months compared to the 12 months before. In other words, April to April was higher than March to March. What's that all about? Those numbers are in here. If you're really curious, you can add it up and kind of see what it does for you. But the month to month is usually up. Okay. Well, our month to month was down in closed sales. A lot of us felt that, the April closings were mostly contracts that went into escrow pre-COVID. So the question is, why did that number go down if those are all pre-COVID? My guess is, if you look deeper, you'd find that that's probably sale fails. Otherwise, that number should be kind of more in line with 2,400, 2,500, maybe even more, okay? But why did it go down? I mean, it's basically down 14.5% over March, and it's down 16% over April of a year ago. Curious minds want to know. Everyone's seen this graph 1,000 times. Conventional wisdom is that a balanced market is about 6 months inventory. I actually use 4 months inventory, just because my observation is if it was 6 months inventory, we should have had a lot more inflation recently, but we've been below even 4 months for some time. For what it's worth, years ago, that number of balanced market was considered 8 months. Lately, conventional wisdom is 6. I'm a little more aggressive in that. But, a balanced market is, prices don't go up or down. They're pretty much level. Well, we've seen prices stay pretty much level. First half of the year, it went up a good solid amount, but we're well below that mark. So why is that? Just a quirk. But what's it look like month to month? You notice that what we got is we got long-term trends there. I mean, this is that's the recession, right? And then I did 3 years just to see how it's doing. How does April compare to April? You can't see that there, but here, April to April. Well, April a year ago was 2.2 months, preceded by 2.2, 2.8 that. Well, we went from 1.8 to 2.4. Is that significant? I don't know. It's a 33% increase. So it seems to be notable. Does that change the dynamics of the market? Probably not. But people might complain. If the news talks about there being a 33% increase in inventory, well, one, we're not talking inventory as in how many houses are on the market. We're talking inventory in months supply. In other words, how many on the market divided by how many closed. So it's a very different thing, but you might have to be explaining that to people. To that point, here's another new graph, same data as this one, broken out. So what is months inventory? It's the gray bar divided by the black bar equals the red line. All right. So if you look at all those numbers, April, for instance, 4757 divided by 2015 equals 2.4. That's how months inventory is calculated. And this could be pretty useful for saying, is it more about closings or more about homes on the market? And in this case, it's some about homes on the market because of the increase. You have your active listings change there, goes up, but you also then have your sales go down. Okay. That will increase months inventory. In other words, you went from whatever these numbers are, 4,200 to 4,700, and then 2,300 down to 2,000, makes you go from 1.8 to 2.4. When people talk about months inventory increasing, these are the components. I think this is a really useful slide. Of course I did. That's why I made it. Pending sales, same thing. So months inventory tells you what's been happening. And the assumption there is that your sales rate will continue, and that's what it is like going forward. Pending sales is what you're going to expect to see in the next few weeks. So based on that, on pending sales, our month over month is usually up. 2018, it went up March to April. 2019, up March to April. We dropped. We dropped 13% since March of this year. More significantly is the big drop from a year ago. We went from 3,100 in April last year to 2,000. So that's COVID for you right there. Okay, that's a huge drop, 34% drop. So what does that mean for our May and June closing numbers? They're going to be smaller. Interestingly, though, if you added up these numbers here, the first 4 months of the year, that sums to about 10,093 in 2019. And in 2020, it's 9,257. So that number is only down a little over 8%. So part of what's going to help in all this is that we had such a strong start to this year. So we had a lot of sales the first part of the year, because some of this still reflects, through March, we're actually ahead of last year. But through April, we're only down 8% compared to the first 4 months of the year last year. And our prices are up. So our prices are up. Our sales are close enough. Our inventory is healthy. What does that look like going forward? Because the main numbers will be down. So you need to get ahead of these conversations. Okay. Months inventory based on pending sales, same graph as the months inventory based on closings, but just saying what it kind of looks like. Okay. Different data, same idea. And then the active pending ratio again for the last 3 years. So it increased to 2.3 months in April from 1.8. It increased to 2.3 from a year ago. So those numbers are all up. So the story there is, again, May and June, sales are going to be down. Whether prices will be down or not, hard to say. I'm guessing they're going to be up. There was a fairly interesting article in this came out of Zillow, and came out it was a couple weeks ago, but they're talking about new listings being down 39% year over year, but listings of the most expensive homes are down a lot, while less expensive homes less so. All right, what does that mean for pricing? Is it going to be the high price? So the issue there was, and this is a different measure. This is where they're talking about what are the median and average price homes on the market, not what is sold. I haven't done that, but they're saying that based on this, that the average listing price will go down because there's more high-end homes taken off the market than affordable homes. So I haven't I haven't tracked that, but that may come up. And so when people ask, well, what parts of the market are doing what, I would speculate that in Portland, if that number comes up in conversation, it's because of the composition of the homes on the market, not necessarily related to what the actual prices are. Okay. All right, that's it for today. Open it up for yakety yak.